Hi, this is Alan Gassman in quarantine in my secret bunker. I'm here with Brandon Ketron, and we're talking today about PPP loans, what's still hot and what's not. And I apologize that we're flooding you with presentations, but we wanted to hit these in 30-minute intervals. So today at 4 o'clock, we're going to be with Kevin Cameron. We're missing his picture here, and he's much better looking than we are. Kevin's a really bright CPA, and he has spent a lot of time and thought in a spreadsheet for PPP loan tracking and forgiveness. And he'll be joining us at 4, and everyone who attends, this is a free presentation, and you'll get a free Excel copy of his spreadsheet. Then tomorrow morning, Brandon and I will talk about what medical practices need to know. And unfortunately, there's a lot of that. Wednesday, another free one, hosted by Interactive Legal. Marty Schenkman and I and a couple of marketing consultants are going to talk about how to market a legal practice. Of course, Brandon and I don't do any marketing. Then Thursday, we're going to talk about what we've learned in the last week on PPP loans. It's going to be more of a technical talk. That's also free. Thursday for Interactive Legal, not so free. I'm going to be with David Finkel talking about how to survive and thrive during a pandemic. And then free on Friday, PPP questions were most often asked. Brandon and I will handle. And then not so free Friday from 3 to 4. So that's actually 120 minutes, not 60 minutes. Oh, it is 60 minutes. Okay, Lissy, we're going to talk just about loan forgiveness, how to calculate it, the rules relating to use and repayment. Saturday, Ken Crotty for free is going to talk about cornflakes and estate planning mistakes. So it's all free if it's blue, and it's not so free if it's yellow. And more webinars coming up, and sorry that this turned out to be an advertisement. Now, here you have our table of contents for today, and the hotter items are in red. Brandon, do you want to give us 10 seconds on each item so everyone knows what we're going to cover?
Sure. So the first one there is this HHS Provider Relief Fund. They came out with some more frequently asked questions in the last few days that indicate that you have to estimate your lost revenues from the coronavirus. If your lost revenues do not exceed what you've got as a distribution under this Provider Relief Fund, you have to return the money, or at least the excess. And not only are you taking into account your lost revenues, but you're also taking into account what you've received from the PPP loan that's going to be forgivable, because that's going to be a reimbursement from another source. So you have to take that amount into account as well when you're deciding whether or not to return this money. The SBA came out and issued a notice for the economic injury disaster loans, or the EIDL loans. Those are now only available for agricultural businesses. So farmers are the only ones that can apply and receive these loans. We have some updates on the employer retention credit, and if you return the loan by May 14th, which is the safe harbor for the necessary standard, if you return the loan by that date, it's like you never had the loan, you're deemed to have complied with the certifications, and then you become eligible for this employee retention credit, which offers a payroll tax credit, and we'll go through those slides in some detail. Senator Marco Rubio gave a town hall yesterday provided some guidance for everyone on what the SBA and Treasury are doing. We're supposed to have some regs this week on the necessary requirement and on loan forgiveness rules. So we'll see what they say when those come out. There's been a couple of lawsuits filed against the SBA on this necessary requirement. So we'll go through, what they're saying in those lawsuits. And we have some just guidance on the PPP loan forgiveness rules, our interpretations of the 75% rule, where you have to use 75% on payroll costs in order for the loan to be fully forgivable. So we'll discuss that as well.
And there's a lot of misconceptions on the 75% rule. The New York Times reported last week that if you didn't spend the full 75% on payroll, you've got no forgiveness at all. Brandon and I read it that you get as much forgiveness as you spend on payroll. You just don't get to write off the utilities, the interest, and the rent, except to the extent of a percentage of what you spend on payroll. But time will tell what the real story is, and hopefully that will be one of the things that Marco Rubio gets the SBA to straighten out. To the best of my knowledge, Pinellas County is still offering no cost, no symptom COVID-19 testing. Nobody's told me they aren't. If anyone wants to update on that, if you've gone and gotten the test, what the process was like, we'll be glad to relate that. I think everyone here probably knows that on or before April 24th, most medical practices and medical businesses received part of the $20 billion disbursement. That was based upon 6.19% of their 2019 Medicare money, but they want to put out a total of 50 billion. And the way they're doing the 50 billion total is they're going to circulate another 30 billion. And the way they're going to divide up this 50 billion is to take 2018 total revenues. That's not just Medicare revenues. That's 2018 total revenues. Divide that by $2.5 trillion, and that is your client's percentage of the 50 billion. Once your client knows what their dollar amount is of the 50 billion, if that was more than what they got on or before April 24th from the first 30, then they get a piece of the next 20. But if what they got in the first tranche on or before April 24th is more than their overall percentage of the whole 50, then they're not supposed to get any more. And one question we get is, should they apply anyway and maybe accidentally get more? And our answer has been, why not? Maybe that'll help. We don't know of any mechanism whereby if they got more than their share of the 50 billion, that they would have to give some back, assuming that they had sufficient COVID-related losses. And we're going to go into a little bit more detail. So we have the math here, we have the summary here on page 17. If you're not clear on it, just send us an email, put in the RE line, more on medical. You can attend tomorrow's webinar at 9. We'll be going into more detail, or you can, if you can't attend tomorrow, let us know, and we'll send you the video on tomorrow. So we have more slides on this, which explains what we've just said. Brandon, what's hot and what's not in this area as far as the calculation of, number one, you have until tomorrow at noon. If you haven't applied for your share of the 20 billion tranche, what do we know about gross receipts being defined and estimates of revenue losses at this point?
Yeah, so when you go on the application to apply for this additional $20 billion disbursement, you have to have this information. Now, this gross receipts or sales comes from your tax return. If you have an 1120S or a 1065, this is going to be your gross receipts, which is generally that first line, line 1 on your income tax return is where you're going to find this information. Now, this estimated revenue losses, this is something that you may have to reach out to your CPA or help your clients with to make this calculations. You're looking at revenue in March and April of 2020 compared to prior periods, and you can compare the two between maybe revenue in 19 or revenue in 18 to get the estimated revenue loss. Or if the doctor or provider had a budget prepared and had estimated revenue projections, you can use those projections to determine what your actual revenue loss was compared to what you actually received. But you have to use a reasonable method to calculate that, and there is some guidance from the SBA on how, or the HHS, Department of Health and Human Services, on how we're making those calculations.
So we'll go in further into that tomorrow. Well, what do you have here on slide 23?
Yeah, so this was added on May 6th, and basically what this is saying is if you do not have or anticipate having revenue losses due to the coronavirus, or if you received an amount in excess of your revenue losses, then you have to return the funds to HHS, and they give us some guidance on how we are doing that, and we'll have that in some later slides. If you think you've received it in error and you shouldn't have received it, you still have to return the funds. So these are all calculations that everyone's going to have to make. We're going to have to compare this to what we've actually received and then return the excess if it exceeds what we got.
And I was amused and horrified by the fact that they said, if we sent you a little bit too much, return it all, and then we'll give you what you're due later. I'm not sure what the definition of later is. I hope that it's sooner than when they cure the virus, but there will certainly be a lot of people caught up in a lot of confusion, again, that we will discuss later. Now, they did clear up, just I think last night, to be absolutely clear, that when they say that this is only available to providers who have provided diagnosis, testing, or care for individuals with possible COVID after January 31st, they say every patient is a possible case of COVID. I guess as long as they were alive, but they don't even say they had to be alive, but they do say every patient was a possible case of COVID. And they say that they will have significant anti-fraud monitoring. So I'm sure we're going to see arrests very quickly, and I'm sure that South Florida is going to have more than its share of this type of thing, because South Florida always has more than its share of medical type reporting crime. Now, to clear up a little confusion, there is another definition of presumptive cases of COVID-19. If a medical practice gets these loans and there is a presumptive case of COVID-19, then they can't bill the patient more than what the copay would be on the patient's network, even when the patient comes to the doctor out of network, but they don't tell you how you're going to figure out what the network where the patient was charging. So I guess you'll have to estimate it and then give the patient the difference later, or tell the patient you'll balance bill them when you find out from the network. Otherwise, the language was gray, but that is their clarification there on page 29. No greater than what the patient would have otherwise been required to pay if the care had been provided by an in-network provider. I was hoping it would just be based upon a typical network, but they want to base it upon the actual network. And then here's confusion. This will be hot if they don't clarify it sooner. They say that when the hospital contracts with an independently contracted provider, that the independently contracted provider is banned from balance billing any presumptive or actual COVID-19 patient. Well, I think this means that if the hospital employed the physician and the physician did the work, then the hospital pays for it and the hospital gets reimbursed. Then the hospital pays the doctor a salary. But what about where the hospital has a staff contract where the anesthesiology group or the radiology group separately and independently treats the patient and bills the patient? There is a contract with the group. Does this mean the group cannot bill at all? I'm sure all the national associations will be all over this in about a week and a half, and maybe this will be resolved soon. But in the meantime, we're telling our group practices that are independent, not employed by hospitals or owned by hospital systems, to go ahead and bill at the network rate as if the COVID patient was still in the mix or still in the network. So Brandon, what should we go to next?
Yeah, let's jump ahead here through to some of the recent updates here on we mentioned the EIDL loans here on slide, let me back up a little bit, on slide 42, that there was a notice posted on the SBA website that these are only eligible for agricultural businesses, and we have the definition of those here at the bottom of page 42. So now generally no one is eligible for the EIDL unless you are a farmer or you're a rancher or some other type of agriculture related business. We still have to abide by this substantial economic injury. Even if you are in the agricultural business, you have to look at the certification. The words substantial economic injury are from the statute, but there is additional guidance on what that actually means. And we have the language here from the website and on the application for the economic injury disaster loans, that a substantial economic injury means a decrease in income from operations or working capital, with the result that the business is unable to meet its obligations to pay ordinary and necessary operating expenses in the normal course of business. Now, this language on this application came from a prior regulation issued by the SBA in November of 2011, and we have that regulation here as to the general eligibility for economic injury disaster loans, and provides more guidance on how this might be interpreted if they look into whether you required and met that certification. So let's keep that in mind if we're advising people to apply for EIDL loans, or if you've received one and maybe didn't meet this standard, consider returning that money. We know that it's going to reduce our PPP forgiveness anyway. So if we're worried about the standard, it might be prudent to just go ahead and return that, since we have to repay that back anyway if we have a PPP loan. Now, the PPP loan, we have our guidelines here as to how much we can borrow, how much can be forgiven, what we can use the funds for. The IRS issued this notice on the non-deductibility of expenses that are paid with PPP funds, and we have forgiveness of those later. So if we're paying our payroll, we can't later deduct those payroll costs as an expense on our tax return, at least according to the IRS. Now, there has been some indication that Congress may issue a technical correction to the CARES Act that provides that these expenses are in fact deductible, that their intent was for them to be deductible and not included in income, to provide a double benefit to small businesses to help them through the crisis. But as of right now, you can't deduct these expenses, but that may be changed here in the upcoming, in the near future. And we have the guidance here from the Senate Finance Committee chair, as well as the House Ways and Committee chair. So these are people at high levels of Congress indicating that this is not their intent to have these non-deductible. We did have one important update to the SBA frequently asked questions since we last presented this for everyone. They have provided that if you have someone that's laid off and you're bringing them back during that 8-week period, to make sure we have the same number of employees during that 8-week period as we had in prior periods, because we know if we have a lesser amount of employees employed during that 8-week period, we have a reduction in our loan forgiveness. Now, the question was, what if I make offers to bring everyone back and they don't want to come back, whether that's because they're afraid to come back to the office because of the coronavirus, whether they can't come back to the office because they're quarantined? How is that treated for my loan forgiveness calculations? And these regulations and frequently asked questions guidance said that if you make a written offer of rehire to the employee and they reject that offer and you document the rejection, that you don't have to take them into account for purposes of a reduction in headcount, that you can treat them as if they were employed. Now, you don't get to add what you would have paid them during the 8 weeks, so we still have to spend our full loan amount during that 8-week period in order to have it forgiven. We're just not going to have a reduction of what we actually spent due to a lower number of employees on the payroll. So we have our steps here to make this calculation. Number one, we're measuring our expenses during the 8-week period. We have that total spent during the 8 weeks, and that's the amount that's presumed to be forgiven. Now, there's 3 reductions to that amount. Number one is if we don't spend at least 75% on payroll, we could have a reduction due to that, and we'll go through the calculations here in a couple of slides. Number 2, we have the headcount reduction, where we're comparing the number of employees during the 8 weeks compared to prior periods, which is what we just discussed. And then we also have a further reduction if we reduce salaries for anyone making less than $100,000 by more than 25%. And we need additional guidance on this 4th step, because under the statute, we're comparing 8 weeks of salary during that covered period of our loan to what we paid in prior quarter, which is a 12 or 13 week period. So we need guidance on how we're matching those up, whether we're doing it on a per week basis, whether it's a monthly basis, or an annual basis. We need some guidance on how those calculations are made. So we have the formula here for the calculation of your total number of employees. If you make that written offer and they reject that offer, you can still include them in the numerator here for determining your number of employees during the 8-week period. But as I mentioned, you don't get to add their salary, so you may still have a reduction because you can't spend the full loan amount on your employees for payroll costs, since you don't have the same number of employees, but you're not going to get a further reduction. Now, the Another guidance came out about this May 14th safe harbor, which is the date that you have to return the loan by. If you don't meet the certification, you can return it by May 14th with no penalty. The question was, under the statute, we know if we applied for and received a payroll protection program loan, we're not eligible for this employee retention credit. So if we return it by May 14th, are we still eligible for this retention credit? And the SBA said, yes, you're still eligible. It's treated as though you had never received the loan, so you can still receive this employee retention credit if you didn't meet that safe harbor and return the loan by May 14th. Now, if we return it after May 14th, say we return it on the May 20th, we're not eligible for the employee retention credit, because then we're treated as actually receiving that loan and not returning it by that date. And we have the calculations here for that retention credit if you're interested in those calculations. Alan, you want to touch a little bit here on the bankrupt entities and the recent updates in that regard?
First, what do you want to bet that they'll extend the April 14th deadline so that more people are encouraged to send the money back and trade for the credit?
Yeah, I would bet that they are going to extend it, especially since we have not yet received guidance that they've promised as to how this necessary standard is going to be met. When they extended it originally to May 14th, they seemed to indicate that we're going to get guidance on how, some sort of guidelines on how necessary is applied. We haven't got that yet, and that date's approaching. So I bet they extended another week.
Are we going to talk about what Senator Rubio said now, or are we going to wait?
Yeah, we can jump forward to that. Let's see. It's on a couple of slides here. Forward. One thing I think to point out here while we're on our way there is they are now charging people for fraud associated with the PPP loans and other SBA loans. These businesses up in New England basically created fake employees in a fake restaurant. They applied for the loan, got around $438,000, and the SBA caught them, said, we have no records of your business, no records of your payroll. You're not eligible for this loan, and you've committed fraud. So, watch out for that. Don't be creating fake businesses, which I think everyone knew beforehand, but just to point out again that they are going to just look at this.
Exception doesn't work, right?
Right. So we had the town hall on yesterday that Marco Rubio gave with the FICPA. There was a question and answer type format. He started first talking generally about some of the background into where we're at with the virus situation. And one of the things that came out from that, which I thought was interesting, is he was saying that businesses really need to be thinking about this in the worst case scenario. And this goes back to whether the loan's necessary. He's like, we should be thinking that the vaccine may not be available until December of 2021. So that's a long period of time that we're going to have this virus floating around, uncertainty when we're going to see spikes, when we might have to go back into shutdown. When things can really get back to normal might not be till December of 2021. Now, he said that may not be the date. That's just what we should be thinking about when we're looking at whether or not these loans are necessary. So I think that helps us with that standard. We're looking at this for a long period of time. There's no reason why we shouldn't increase our capital now by getting this loan and helping us get through the crisis. The other thing that was interesting that came out as part of this was this idea that the SBA may provide in the guidance that if you have a loan of $350,000 or less, which is around 95% of the loans outstanding, that it's going to automatically be deemed necessary and that you complied with the certification. If it's over $2 million, we know we're going to have automatic audits of those loans, and you're going to have to provide guidance as to why it was necessary and how you made that certification. And then he said there's probably going to be some sort of tests for the loans in between those two amounts. So we'll see what the guidance comes out with, and hopefully we'll get that sooner rather than later. But those are some interesting items that came out of that town hall webinar. Another one to point out, he was asked about the paid and incurred standard. So we know that we count during the 8 weeks cost paid and expenses incurred. So the question was, how are we applying that? That's not a formal method of accounting. That's a combination of cash and accrual. We're not familiar with how that works, and especially for retirement plan contributions. Sometimes those are made at the end of the year. If we pre-fund those, are they going to count as being incurred, even though they're also paid? And he said he's going to take those questions to the SBA. He hasn't had formal communications with the Treasury on that type of question, but he is going to take it to them and hopefully get them to provide guidance to us on how retirement plan contributions specifically are going to be treated during the 8-week period. All right, I'm going to jump forward now to, here's another interesting item that came out since the last one, is that some businesses have actually filed suit against the SBA on this necessary requirement and said that the SBA didn't have the authority to do this. It limits the ability for businesses to receive the loan, and they're seeking an injunction against the SBA to keep that from applying, and that this certification is not going to be required, at least to the extent that the SBA implemented it.
And we've written about these lawsuits on the Forbes blog. If you Google Gassman, Forbes, Mayday, M-A-Y-D-A-Y, they come up. We have a more extensive article coming out on the Limeberg system tonight. We'll send that to everyone who's attending this tomorrow. You'll get a copy of the Limeberg article that's going out tonight on the Limeberg system, which will just give a little bit more detail on these lawsuits and on whether the SBA has the authority to say that in determining whether a loan is necessary, do you consider whether you have access to capital or the ability to borrow money? If your business or practice happens to be owned by somebody who has a lot of money, why is that business or practice treated differently than a business or practice that may have been mishandled over the years and held by somebody who doesn't have enough money or enough credit? Shouldn't they both be able to borrow on the same terms and get the credit for this PPP program or not? And hopefully there'll be more guidance before May 14th, but probably not. It'll be May 14th will be an interesting day for us here. Many clients have us writing letters and helping them to evaluate whether the necessity standard is met. We are using the accumulated earnings tax as a comparison mechanism. We are helping clients prepare timetables to show exactly where they were as a business and as a going concern, and exactly where the virus situation was at the time where they filed their applications, at the time they received their monies. And certainly people need guidance on what to spend in the 8 weeks following the loan. The New York Times incorrectly reported that if you don't spend the whole 75% on payroll, you get no deduction at all. We believe that you're going to get the deduction to the extent you spend money on payroll, and then to the extent you spend a certain percentage on the other items that are permitted, you're going to get the deduction. So a little deduction is better. I mean, a little forgiveness is better than no forgiveness. The rest you can hold, repay them at 1% interest. It's non-recourse. If your business fails and you've reasonably managed your business, you shouldn't have personal liability. So Brandon, I left you 2 minutes for the rest of the presentation. Is there anything else we want to cover, or have we covered the truly hot items?
Yeah, I just want to go through an example here of the 75% rule, just to show what our interpretation of it is. And we don't think it's a cliff. And one of the reasons why I don't think that is here, they said that the 75% rule really came from this 8 weeks out of the 2.5 months, 56 out of 76 days, which is 74% rounded up to 75. So if this was a cliff rule, if you paid the exact same amount during the 8 weeks that you got the loan for, you're under 75%. So you would automatically get no forgiveness at all. I don't think that's what the statute intended. I don't think that's what the SBA intended either. So I just wanted to point that out. And here's the way we think it's going to work, just with a simple example. And say you have a $100,000 loan amount, you spend 70 on payroll costs, 30 on non-payroll costs. So you should get the entire amount forgiven, but for this 75% rule. How does this actually work? We think you get credit for the full $70,000 payroll cost, but the non-payroll cost portion, this $30,000, is limited to 25% of the forgivable amount. So you have to run a ratio. What percentage of 70,000 would make my forgiveness amount be equal to 25% non-payroll costs? So that's around $23,333. You plug that number in, and you have to, there's algebraic formulas to get there, and we'll provide more input on that in some future presentations, but I did this quickly this morning. So you would get credit for $23,300 of those non-payroll costs. So then your forgivable portion of non-payroll cost is equal to exactly 25%. You get credit for the full 70 payroll plus those non-payroll costs. So that's how we think it's going to work. Hopefully the SBA will give some guidelines and improve us right here, but we'll wait and see what comes of that.
Okay, don't forget creditor protection planning, as clients hopefully will recover from this, but maybe not. So don't forget creditor protection planning. Join us this afternoon at 4 o'clock with Kevin Cameron, so you can see what he looks like, and you can use and work with his spreadsheet, which he has so generously offered to make available. Tomorrow morning, 8:30 to 9, we're going to be talking about medical practices, reiterating some of today, but also getting more into the nitty-gritty. Tomorrow, marketing your practice. Thursday, PPP loans, what we learned in the past week. These are all free of charge. And then not so free, David Finkel's presentation on strategies and tools for running your business. And again, the most common questions, free on Friday, and not so free, PPP loan forgiveness, permitted use and repayment rules, exactly how the repayment rules work. Well, I'm sorry there's so many darn webinars this week. We just thought it would be easier for us and for those of you who could stand them to do them in 30-minute intervals to let us ramp up to what we hope will be a really good performance for Limebird on Friday. Thank you for being the guinea pigs. And of course, Saturday, cornflakes and estate planning mistakes. Have a wonderful rest of the day. May it be mostly billable. Thank you.